So Rivian has told investors it will be gross profit margin positive by the end of 2024. So in this video, I wanted to highlight the progress it's making so far and precisely how it's making improvements in its profit margin. So let's get right into it. So in the first quarter, Rivian saw about a 17% improvement compared to the fourth quarter in terms of gross profit per delivered vehicle. That's a big improvement in just one quarter. So we were able to deliver that improvement despite the fact that we produced and delivered fewer vehicles in that time frame. So typically, Rivian will experience improvement in gross profit margin as it produces more, but in this specific quarter over quarter improvement, none of that improvement was due to an increase in production. So that was impressive. So as supply chains have gotten better, freight costs have also improved. Remember, freight shipping expenses were extremely high during one point during the pandemic. Those have come down significantly. So that's one area that pressure has been reduced. And then beyond that, we saw increases in our average selling prices. So a lot of that was driven by a more significant mix shift to R1S in the first quarter. Remember, the R1S is the SUV, and Rivian has said that the majority of their customer orders are now for the R1S. So more and more people are buying the higher priced R1S. So as we look more towards the back end of the year, we start to get some of the benefits of the Enduro introduction into the R1 vehicles. Enduro is their new drive unit that makes it less expensive to produce each car. We'll also start to see some average selling price increases we introduce the Max Pack towards the end of the year, as well as ramp up production. And now that Endura is sort of unlocking our ability to really lean into the installed capacity that we have today for the R1 vehicles. So several things in there to unpack. Number one, they're selling cars at higher prices for two reasons. Number one, consumers are choosing higher priced models. And number two, they're introducing more premium models like the Max Pack, which allows greater battery range. Secondly, they're ramping up production, and as I noted, when they ramp up production, it increases profitability because they've already got capacity set in place. So they've already paid for that manufacturing capacity. They can produce up to 150,000 units. Now in 2023, they're only planning to produce 50,000 units. So the more they approach the max capacity, the more those costs get spread across more units, lowering the cost per unit, the cost per car. And so that increases profit margins as well. And then finally, the new Enduro drive unit makes it cheaper for the company to deliver, to produce, to make these cars because they've learned how to optimize production, where they can get these parts, where they can make improvements on. So the CFO saying we'll start to see improvements in our overall sell prices towards the end of this year. There's a bit of a lag effect related to how quickly we'll realize some of the cost benefits, but those will be significant savings as we've gone through this period of significant price inflation, and we'll see moderation in the backdrop. So let me talk a little bit about that second point there, the lag effects between the cost reductions. Remember, during the earlier parts of the pandemic, or I would say not the earlier, the mid to later parts of the pandemic, inflation exploded, especially for inputs for electric vehicle production because there were so many companies ramping up EV production that competition caused prices to soar. And what typically happens for companies like Rivian is when prices explode like that, Rivian doesn't experience the increase immediately. It typically takes a couple of quarters because the supply they have for this quarter and next quarter and probably the quarter after that, they've already probably locked in sale prices and inventory and cost of goods and raw materials for the next 3 quarters. So they've bought these things probably several quarters ago at the lower prices. So when the prices increase, they don't feel it for a few quarters. And then when they start to order the newer inventory, the newer raw materials, that's when they start to feel the increase in cost of goods sold. So that comes in with a lag a few quarters later. And so the same thing on the downside. Now that prices have collapsed in terms of raw materials, in terms of battery costs, in terms of transportation, all of that, they don't feel that decrease immediately because the raw materials, the inventory, all of the things they have right now, and probably for the next couple of quarters, they probably locked in those prices a few quarters ago at the much higher rates. So now that prices have come down, they'll start to really experience the decrease with a lag, probably starting maybe in the fourth quarter of this year and beyond that starting in 2024. So that's why companies like Rivian, when you see cost of goods sold fall tremendously, and then you look at the company and you say, why aren't your costs falling? It's typically because there's a lag, right? And I hope I did a good job explaining those lagged effects there in terms of profitability. So for all of those reasons, that's how Rivian is expected to boost its profit margins for the rest of this year and moving forward throughout 2024 with the aim hopefully to be gross profit margin positive by the end of 2024. And with the looks of it, I would say that's a realistic target for now. The way things are looking, the way material costs and everything is looking like, it looks like a realistic target, but it remains to be seen. All right, and for sure, I will be providing you updates on Rivian's progress towards profitability. But that's all I've got for this video. Thank you so much for watching. I want to thank the Motley Fool for sponsoring this video. Visit fool.com/Parkev for the 10 best stocks to buy now.